So, Bill Park, thanks for spending some time with us today, and we're excited to have you present. If you don't mind, just giving an introduction about yourself, and then jump into your presentation. Then we can go to Q&A.
Great, awesome. Thank you for having me. Thanks, everybody. It's great to meet. So I'm Bill Park. I'm a Salt Lake City native. I'm a CPA. I'm the CFO and partner at Cross Creek Advisors, ex-Deloitte. And I'm a father of four. So at Cross Creek, we manage about $1.5 billion and invest in late stage investments and other venture capital firms. So I think the official count as of today is we're in 78 other managers and about 200 other funds. And we've made roughly 115, 120 investments over the last 15 years. And, you know, Taylor's been a great friend over the years. I think we met in college a long time ago. But I've enjoyed this group. I've actually got to learn a lot and had some interesting networking opportunities. So I hope it's the same for you all today. And why discuss equity? Well, a large portion of my time is spent on equity issues. So I thought I'd have something valuable to say. You know, we look at prospective investments. It's an analysis we do, and it's something we spend a lot of time on. We also spend a lot of time looking at the equity roll-up, or I will call it the capitalization table of our current investments. It's an analysis we do regularly to understand the motivations of the other people we're working with. And it's something I deal with as an operator at an operating company. We have employees and we try to incent them appropriately and get alignment as a team. So I think if you're not currently dealing with equity issues, either as an owner, either through options or other opportunities, or as a founder, you know, it will hit you at some point, hopefully. I think it's a great part of the American dream. I think it's built a lot of the ecosystem we're in is the opportunity to own equity. And it creates a lot of different challenges at different levels. And so my goal is to help you think through current and future challenges as you look at the opportunities you'll have to buy and sell portions of businesses you're working with. My frame of reference is in private companies. So this isn't going to be a discussion on what to do with public equities, but really more if you're building a company, how to think about it, or issues you should be thinking about, and if you're an employee of a company considering equity options. And as my dad used to say, there's no dumb questions, only dumb people. So speak up. If you've got a question, I'm happy to answer it. If I say something that you disagree with, also happy to answer it. I think it'd be lovely to have a conversation. So I'm going to pause there.
That was funny, by the way.
Thanks. Thanks.
No dumb questions, just dumb people.
Just dumb people. All right. So let's dig into some framework. So this is called managing equity. I thought titling it something along the lines of how to think like a VC was incredibly pretentious. And that if I called it how to think like an accountant, no one would join. But really, this is frameworks for thinking through equity decisions, or how actors in an environment with equity will interact and work together. So why think in frameworks? Well, the big thing for me in my business, or as I've matured in my career, is that it helps me understand other points of view. If you're dealing with parties and you're mystified by the moves they're making or the decisions they're making, oftentimes it's because you're not working under the same frameworks, or you're misunderstanding what they're optimizing for. So hopefully by laying out a few key frameworks that investors use regularly, you'll be able to understand the moves investors are making, the moves founders are making in response to the investors, and the moves employees are considering as you go through your day-to-day from an option perspective. So there's really two key perspectives that I want you to keep in mind as we think about these topics and these frameworks, and that's from the buyer and the seller. And I'm going to try to address them. If I miss it, chime in and say, hey, Bill, what about the seller's perspective or the buyer's perspective from those frameworks? The other thing that's great about frameworks is they help you ramp on issues or topics very, very quickly. A large part of our job in a venture capital firm is to find the right framework to apply to the problem that we are considering, which either can be how to deal with a management team or how to select the right investment. So a good framework will change the way you watch the game. I mean, that is how you're interacting or how a scenario is playing it out. It'll give you a new perspective on it. And it will also help you anticipate outcomes where you will be able to understand or guess at what the next right move would be and how that's going to impact the decisions or the discussions you're having. So a great example of this is the pick and roll. My son turned 8 earlier this year and started playing junior jazz. I'm not a basketball guy, and so I kind of had to dig in a little bit to understand the basics of how the game's played. The pick and roll is one of the most popular offensive plays in the NBA. And I found that if you actually understand how that play works, watching an NBA game is infinitely more entertaining because you understand the decisions the ball handler's making, as well as the rest of the team's making, as well as the defense making. So funding's no different, where once you get an understanding of the frameworks people are using, looking at a balance sheet, whether it's so equity or debt funding or consumer or customer funding makes a lot more sense, and you get to understand the power in a business model or the decisions management's making. So I'm still much more comfortable looking at the lower graphic than I am at the higher graphic, but they're both interesting and entertaining to me. So moving on, we're going to dig into a few examples. And again, hop up with questions. I don't want to burn through these too quickly, but the pick and roll of finance is a bird in the hand is worth 2 in the bush. This is the foundation for all decisions that we make on a finance side. It's also known as the time value of money. Hopefully, it's a concept you're familiar with. If you got a business degree, you probably spent an extended amount of time discussing this topic. I'm not going to go into it too much, but I do think I wasn't even going to bring it up, but I really think it's impossible to have a discussion about a topic so related to investing, such as equity, that you don't at least touch on it. The culmination of the theory of the time value of money, or that a bird a day is worth 2 that you don't have yet, is the discounted cash flow. I'm not going to walk through how to do a discounted cash flow or the value of a discounted cash flow. We'll talk about some of the inputs, but there's some really useful videos or articles here I've linked to, and I'll post these later. All these hyperlinks go somewhere that will teach you the ins and outs or give you a better perspective on them. It's really about distilled down timing and risks related to cash flows, money you put out and money you expect to get back. So as we think about kind of the investor IQ bell curve and where the big thoughts are happening, most people spend a lot of their time right in that middle section. I've spent a ton of time grinding it out, building 10-year forecasts of 3-year statements, and, modeling WACC and sensitizing for various macro risks. But really the simple question is the question that matters the most. And that's, when do I get my money? Going through the details, the financial details of understanding a business from a discounted cash flow perspective is hugely valuable. And I still really enjoy it, but it's critical as a founder, as an employee, as someone making financial decisions, investment decisions, like, when do I get my return? That's all that it boils down to. A mentor of Taylor's and mine, Troy D'Ambrosio, used to say, with a 6-pack and a spreadsheet, I can build a great investment thesis on a weekend, which is very true in a very tongue-in-cheek way of saying the details of the DCF don't really matter. It's how it helps you understand the business. So I wanted to touch on that. The topics will come in, but hopefully it's not overly intimidating to anybody. I'm going to pause there after talking about that first kind of key framework. Any questions or comments? Great. So if you're interested in VC or private deals or what it takes to get funding at the private level, a key read is Brad Feld's Venture Deals. He also has a blog, and a lot of the topics he talks about are discussed on that blog. It was one of the first books I bought when I started at a VC firm, and it goes through term sheets in great detail. But at the middle, there's one page, or at the beginning of the book, there's one page, and it's the message is very clear that if you're discussing an equity investment, it comes down to 2 key factors, and that's economics and control. So the thought of when do I get paid as an investor, or what portion of the proceeds am I going to get in an exit scenario? And the second is, what control do I have over this company today? If you think about an investor's putting in a substantial amount of money, at some point that control shifts from the founder's company to the investor's company because they have more at stake. So the two are very intertwined. Again, I think it's a great book. As I look at cap tables, or as I look at companies or our own investments, to me, I think I would frame it slightly differently. And it's this concept of economics or dilution and alignment. Dilution is really this concept of the portion of a business you own is slowly diluted down, and you own less and less of what's going to happen. So as a buyer, we have multiple options, right? As we go out to the market to deploy capital, we're making relative bets on different companies. And so we look at multiples. We want to know, like, where do I think I'm getting a deal, or which asset is the most mispriced? As a seller, you only have, as a founder, you primarily have one asset. So what matters most to you is how much dilution you're taking for your company, or how much of the company you're giving up. And there's two real levers for managing that dilution. And that's dollars invested, or how much money you need to take today, and the valuation you're taking it at. So VCs are very involved in this. We do this day to day. So sometimes we know how to structure a deal, and it talks about it in the book in more detail. I'm not going to get into the details today on how to effectively move that dilution number based at different exit outcomes. But as a founder, the key to think about is, what do I need to take, and what valuation am I willing to take it at? So to optimize for this, in the best world, it would be, I'm going to take minimal to no dilution for a maximum amount of dollars, which is great. And it can feel good, and you can hit a valuation that looks really good on a headline. But there's real caveats that I think we're going to see, and we'll discuss a little bit depending on how time goes, on how to other frameworks for evaluating raising money or taking equity in should work together. Any questions on dilution? Is the concept clear? I know people feel dumb about it, but it's happy to go. All right. So the next topic, versus control. So control is actual, like, management of the business. I like to think about alignment, because in a lot of ways, control expresses itself in different ways. You could think of assigning equity as like a portion of incentives. I think the incentives need to be considered as a component of alignment, but they're not totally the same thing. I was talking to another seed VC on the plane last week who and I mentioned I was going to give this talk, and we talked about this owner's mentality topic. And it's something that comes up a lot. And this is somewhat, I'm not going to say debated. I think in general is considered a good thing, but I am personally on the more conservative end, where I'd say there's a difference between alignment and owner's perspective. I've seen boards with a lot of ownership and a lot of owners' mentalities, but they have terrible alignment, and it destroys the value of a company. Also, I've seen employees granted equity as a strategy to give them an owner's mentality, and they don't know necessarily how to value it. And it can turn into a situation where you're giving something as a founder you've worked and bled for, and you're giving it away for people who don't actually appreciate either what it is, understand what it is, or have a capacity to utilize it in the right ways. And I've seen that at companies, I've seen it personally, and it's a challenge where I think if you step back into how do we get everybody aligned and moving into the right direction, some component of that is going to be, equity grants, and some component of it is going to be more cash or benefits. But I think if you go all in on some issues, you can hit problems where, like, you can hit a rest invest type culture, which is not good for the creation of value in a company. Or you can hit an active secondary market, which is also not great for a company if you've been too loose with those equity grants. So that's what, when I think of the two key things as you go into any equity transaction, this concept of pricing my dilution appropriately, looking at how much of the company I own and how much I anticipate to own. And we'll go through some different scenarios down below. But also, am I really giving people the right incentives to align them in the right way so that we're moving in the right direction?
Bill, just a quick question on that. You said rest and vest.
Yeah.
Could you dive in a little bit more on that and talk about how you've seen employees or companies mitigate against kind of just that rest and vest versus milestone-based option vesting or other?
Yeah, there's a lot of different ways to structure. It depends on your scale in a lot of ways and getting more complicated schemes. I think to me, the best. So what rest and vest means is you've granted an employee an option. So there's value in it and you want them to have an ownership mentality. But fundamentally, the employee is not motivated to build something new. For whatever reason, the rest of the compensation package or the management structure hasn't been focused on because it's been solved with an owner's mentality, and they are hiding out or they are not giving it the full effort that they could, and they're just waiting for their vesting schedule to come up, or they're waiting for the option to be either in the money or they can exercise it. So that they can leave the company. So that's where I think equity options are an amazing tool and have created a lot of wealth and created many successful venture ecosystems. A lot of people credit Silicon Valley's success with this share the wealth equity option. And there's also been critiques of how we've handled it locally. But I think in a lot of ways, it's getting the right people in the right room and building the right networks and getting them aligned with the goals of the company and what the company needs them to do to create value along those lines. And when I say, so Taylor, did that answer the question?
Yeah, that's helpful. Thank you.
And then we'll talk a little bit about secondary markets, but it's like, if you're building a company, you can get in a situation where employees have vested and are selling it. It can be a great liquidity option to keep people motivated, to give them cash in their pocket. But you can also get into scenarios where you have people you don't necessarily know owning your company and owning material portions of your company. Great. Any other, like this is not a presentation. These are notes to discuss. So if anyone's got any questions, I don't know. I'm seeing some activity in the chat. I don't know if that's just people's comments or
no questions in the chat yet.
Okay. Great. So the next framework I wanted to touch on was portfolio theory. I think if you've spent some time either as an investor with your own personal like 401k or in the private markets, this concept of a concentrated versus diversified portfolio comes up a lot, owning an index versus a few stocks. I bring it up here as you think about the bets you're going to make as an investor or the board you are building as a founder. They're both applicable, right? Like if you go all in. So what I love about venture, I apologize for the yard noise. When I earlier in my career, I worked in Deloitte's M&A practice, and we were in the PE group, and so we were evaluating deals for private equity companies to purchase, and they were running companies wholesale. It's great, can be a great market, can be a lot of value, I guess I would say change hands. What I love about VC is you actually are seeing things being built, and that means you get to participate in various different ways. And so as a founder building your cap table, what it allows you to do is have a diversified set of bets of investors in your company that can offer you different value, but also provide different dynamics at the board level as we talk about that control theory. So it's kind of building up here on the frameworks we're using. But also to understand, like as a VC, you know, a portfolio will have roughly 30 companies in it, which means our bet is much more diversified than the founder's bet who's building the company. And understanding that difference is highly critical. The other thing about these diversified bets is our underwriting perspective. And that comes into the power law, which Peter Thiel made super famous. But it's really just this consideration that a very few investments will create most of the gains. Another way to think about it's the 80-20 rule or the Pareto principle. And it changes your perspective, where if you are optimizing for upside, that lets you be a little riskier, and it lets you focus on higher level issues, such as like why TAM became super critical, or while TAM discussions became super prevalent in the prior few years to, as you discuss valuations, in that it became not like what's my downside. The worst investment decisions I've made personally in the venture space were not issues of buying, but were of selling, where we sold our position in companies because we thought we'd maxed out or whatever reason, and they went on to have an amazing run that could have been fund returners. And so it's that shift in perspective. And as an accountant, it's fairly difficult for me to not focus too much on the downside, but it's a critical part of how people are building their portfolio, how they're considering an investment in your company, what they want to buy versus what you're selling, and how the support they're going to provide, or what they need to hit, what underwriting thresholds they need to hit. The other aspect I just want to touch on is the time horizon. So as a personal investor, my 401k, that money goes into that account. I don't need it for 30 years. Very, very different mindset to a VC, where you've got a limited partnership agreement that limits, one, your investing period, and two, when the fund will legally shut down, right? So at some point, every VC fund just has to stop. And that's typically around 10 years. Some can go up to 15. Some may be more open-ended, but the typical is that person's investing for 10 years. So as you think about the money that's coming onto your cap table, it's important to understand what the horizon is they're looking at and how they're considering that money. So I'm getting subtly wonkier and wonkier, and I think we have about 10 minutes left. So those were the three main ones I wanted.
Well, we've got a couple questions in the chat now.
Can you read them out? I'm having a hard time seeing them.
Yep. Chad said, do you have a favorite shortcut for calculating TAM?
Do I have a favorite shortcut? That's funny. So look, I think in general, the back of the envelope math that we always do is like available customer set times like what you think your average price per contract is going to be, right? And that's a way to get it. I've used to be super critical and poke on these a lot harder. I've back to my distribution of investor IQs. It really just needs to pencil. So like what's the my favorite way, if I was going to say as a private investor, or as I used to write business plans, is to go to some public company that's in the space and steal their calculations. They've paid some consultant to do it. As long as they're close and you can point to it, I think it's super useful and validating. Most S1s have them in there. Most SPAC presentations have them in there. So that's the cynic in me, or the really get it done quick is go.
So
steal
favorite way is straight thievery. Is
straight
what I
thievery.
got out of that.
Someone else has done that work. People pay
Okay.
people a lot of money to do that, and they often come up with even then questionable ways to think about it. But there's probably a space. So we're invested in a pizza delivery app. When we went to go think about the TAM, we went to Domino's S1 or Domino's 10K.
Love it. Love it. Well, a follow on with Chad's question, he asked, do you have any suggestions for understanding portfolio construction? i.e., is your company more or less likely to get funded based on how it relates with the other companies in an investor's portfolio?
Yeah. So portfolio construction is intensely personal or highly subjective. There's some decent books. I can throw them, into my notes here when I publish these, but I think understanding, does the investor have experience in the space? The other hard part about it is they're probably going to know their portfolio better than you will. And so there's one, like, what space are we attacking? Like, is it fintech or is it prop tech? Companies that serve to make property easier to transaction or make those properties more valuable, like, for instance. And then what spectrum, like, are they placing their bets early to more mature, right? Are they placing their bets across the ultimate end consumer? So I think those are some of the things, some of the insights you can get. What's the active portfolio? I know on our website, we list all of our investments ever, and I think you can dig into the active portfolio, but I think being able to speak to the investor's portfolio, at least high level, is a great aspect of it. Unless you know those companies really well, it can become a little bit dangerous. Also, not every company is a portion of that investor's portfolio. So you could bring up a company in the Cross Creek portfolio. I would know it, but there's probably another partner on that deal who knows it a lot better than I do. So it's really, as you think about portfolio construction, what I would focus on is how fresh is the fund. If you're getting an investment from a fund that's 5 years old, like a lot of that capital has been allocated and you may be competing with more names. If you go in earlier, like, and you need capital needs sooner, you may be more fresh in people's minds. Understanding what their reserve policy is. Some firms have a set reserve policy where they'll layer in more money. Other firms underwrite it case by case. Those are kind of the questions on, like, where are you in your fund life cycle? Where are you, and if you come in year 5 and it's a hard close at 10 years, you're only going to have their support for 5 more years, and you have to understand where else in your cap table you're building your portfolio of investors.
Cool.
Kind of rambling answer.
Yeah, that's helpful, Bill. I think one last question, I think timing wise, and then you've got to jump. Jeff asked, do you see SPVs and or series LLCs as effective vehicles for managing equity?
So I, as an investor, dislike SPVs because they charge me an extra layer of fee and carry. Sometimes you can get out of that. They can be great. I think SPVs are a great way if you're thinking about how do I become more of a VC, kind of jumpstarting that. I've launched an SPV, I can start a track record and get in. As a founder, SPVs are super useful for cleaning up the cap table, where you may have a bunch of people who want to get in, but you don't really want to manage the relationship, or they're going to ask a lot of questions. And so it consolidates it to one choke point and keeps the cap table somewhat clean. And you can only deal with the lead of the SPV versus all the underlying people they bring in. I'd point to some of the text that became public in the Twitter acquisition between Elon and Kaliakis, I think, was kind of an interesting view on how SPVs can be perceived if they're not managed appropriately.
Awesome. Well, I know you've got a hard stop, Bill.
Yeah. So
Thank
I just want to end on, like, guys, like, this is my opinion. I've been in it. I'm about 12 years into my career. I've seen a few things, but hopefully it sparks some controversy. And if you have thoughts, I hope you reach out. Feel free to connect with me. I think I've seen a few LinkedIn requests come through. It's time to vote, so go vote. I'm going to leave you on that, but I hope you connect. Hope we talk more. I really hope this was useful, and I will end up posting this to my website here later today.
Thanks so much, Bill. Appreciate it. If anyone else wants to stay for another 5 minutes and just say hello to everyone, I think I'll keep the room open for another 5 minutes. But Bill, thanks so much.